And we're live. Good morning. Money Morning episode number 8. How you doing, Andrew?
Doing well, Richard. How are you doing today?
Yeah, good. So today's topic is when it would be appropriate to consolidate your debt with a new mortgage. It sounds somewhat counterintuitive, I suppose, because you're essentially borrowing your way out of debt. But the key thing is a far lower interest rate on terms that are usually going to be better. So let's kind of kick into the Batman origin story of TDF back around 2004 or 5 or so. And I was working in the credit and collection business. I think it was up until about 2003. And they gave me a package. I went home and I was getting my taxes done, and my accountant was basically just getting into the mortgage business. So he was a full-on a full-on accountant. I think he was, what's that tier just below
CPA.
That one. And yeah, he was looking to try to put deals together, I suppose, for the customers that he was doing tax filings on. And he would often come across people that had loads of credit card debt on their credit bureau, and he figured, well, why not offer mortgage financing to pay it off? And then he started showing me these credit bureaus, and he's like, look, I got this guy that's got 50 grand in credit card debt, but I can only get him approved for a second mortgage for 31,000. What do? I get too many of these. How do I solve this problem? And I just kind of looked at it and I said, all right, well, you can settle the debt, because we had been doing that in the departments that I had worked in credit collections for quite a while, actually. It just wasn't that well known to the public. I mean, now you can go online to Amazon, you can buy a DIY book. I mean, we have a DIY book on Amazon. But so we started to do that, and it turned out to be quite effective as far as making things work. Some people can do it with the equity they have in their house and pay it out in full. Some people need the services of settlement work to make it fit. But what we saw was people were basically trading. Most credit cards are 19.99% interest, all the way up to 28.8% for some retail store cards. Some loans that people take on can be as high as 35% or even closer to 40%, depending on where they acquire the loan from. But most mortgages, at first anyway, the interest rate is quite low. It's usually less than 5% nowadays, less than 4%. And even if you get a second mortgage, even if you've got terrible credit, as long as you have the equity in your home, you can usually borrow the money for less than 13% often, right? I mean, even in the worst case scenarios, it's still around 14%, 14.99, something like that. So we started to do quite a few of those, and we also saw, as we were tracking it from day one to the point when they got the debt settled out, was that their credit score also went up significantly. I mean, I noticed a rise of anywhere at 100, 150 points. I'll stop at that. Did you have anything else to add to that, kind of, to the origin of how we got tied in with mortgage agents and helping them get rid of customers' debts? Because not only do we do it with that one instance, but we also started working very closely with a number of different mortgage outfits throughout Canada. I remember I went to Winnipeg, Ottawa. Like, I traveled around quite a lot around that time to talk to these different outfits, and we did quite a few deals with them. Go ahead, though.
Well, yeah, what you said is you basically hit it on the nail. That's exactly how it started out. I guess most of the business started to come from mortgage agents, trying to send us some subprime deals where they just couldn't make the numbers work. Getting approvals from lenders for, say, 25,000 and had much more debt than 25,000. So they needed a way to make the deal fit if the lender was going to grant the financing. And that's where, TDF came on board and was able to strike a deal and get things done for the homeowner.
Yeah. We also ended up training quite a few of our competitors too, because a lot of people that saw us doing it figured, well, I can do this too, rather than outsource it to us to do it. Why not just do it myself? And literally, it's like the equivalent of a beautician trying to do a transmission rebuild on a car. It's like two different things. They think it's simple and easy, but more often than not, they didn't have a lot of success with it, or they did it wrong, and ended up with problems later on down the road. But that's an entirely different story. So when would it be appropriate for somebody to borrow against their home to pay off credit card debt, Andrew?
Simple response would be somebody that has equity in their property to begin with. They obviously have to have the ability to finance to start.
What does that mean, if you can define equity, just so it's clear for people?
Equity is the amount of value in the property that hasn't been financed. So if the house is worth, assuming $100,000, and your mortgage is assuming $50,000, and you've got $50,000 of value in the house, You obviously will not be able to tap the full amount of the 50,000 from the financing, but you should be able to get 20 to 25, $30,000 from that example. So you can use to allocate towards your debt. So that's the term equity, is how much money you can pull from the property to do something with, pay off debt, renovate the property, landscaping, new vehicle, whatever it is that you're looking to do. So as long as there's equity in that property, that's the first step. The next step is ideally needing to have a, excuse me, a good credit rating. If you have a good credit rating, you get the prime interest rates, and that's when you're talking the 3%, the 3.5%, something like that. So if you're looking to roll in, credit cards at 19.99%, let's assume you have two of those, totaling $25,000. The biggest savings would be if you have the good credit score, where you can get the good interest rate. So you get your new debt consolidation is now being financed at 3% rather than 19.99. That's the prime candidate for mortgage financing to consolidate their debt.
And why don't lenders give people 100% of the value of the house? Like most of the time they stop around 75 to 85%.
Yeah, that's all contingent on the credit rating. The higher your credit rating, the higher that the lender will be willing to give you on the property. So if you've got a very high 700 credit score, then you will get higher than the 75 to 80% mark you quoted. But if you have bad credit, that's when lenders start to cap it out as around 75 to 80%. Yeah. So sorry, what was your question, Richard?
Why do they stop between 75 and 85%? So, I mean, like we know that a B lender here in Toronto will go to 75% for the most part if you've got relatively good credit. And they'll usually lend it up to about 7.99% interest, which is still a very good rate. I mean, so if you got a second mortgage for 7.99 from a financial institution here in Toronto, you're doing fairly well. But if you've got lousy credit, and I'm not really sure where they draw the line in the sand. Do you know where a company like Home Trust, for example, would say no? Like, what is it after lower than 700, 750?
I think it's lower than that. I think it's around 600.
600, yeah. So
I think it's around 600.
And for the most part, I mean, if you're carrying debt and you've been doing it for a long time, so you've been just throwing your minimum monthly payments at the debt. Sometimes you miss a month. You may borrow against one card to pay off the other. Kind of play credit arbitrage, moving money around from one balance to the other. It's like robbing Peter to pay Paul sort of thing. If you do that long enough, then that's when your credit score definitely goes well below that line in the sand where you have to go to a private lender. And then a private lender would do it for around 13%, plus a lender fee. And they may go up to 85% loan to value, meaning, again, let's use $100,000 valuation on it. They might loan you up to $85,000 of the value of the house. So let's say your first mortgage is 50 grand and you've been paying that, and we're just using easy numbers. I realize that a $100,000 home in Toronto doesn't exist anymore, but for the sake of simplicity, so if your first mortgage is like 50 grand and the value of the home on the market would be about $100,000, you may be able to borrow another, $25,000 out of the value of the house to pay off your credit cards at a much lower interest rate. So that's when it would make sense. Now, there's scenarios where, let's say you've got $24,000 in credit card debt, and you got $25,000 that you can borrow against your house. That's all fine and dandy. It's cut and dry. You go to your mortgage agent, they do the deal, they pay off the credit card debt, and then they just, build it into your mortgage payments, and you're just basically making your payments that way to pay off the debt. Now, there's also the scenario where they might have significantly more debt than they have equity in the home. And that's where we kind of kicked off the whole debt settlement stuff with the mortgage industry back, 15 years ago. Can you explain that?
Yeah, so it's basically, as you indicated earlier, we were contacted by various mortgage outfits or mortgage agents looking to get a deal to close. They had a commitment from a mortgage lender that said that they would be willing to give, again, hypothetically speaking, $25,000 as a new mortgage at, again, hypothetically speaking, 12.99% APR interest. However, the condition from the lender was that they wanted all the debt on the credit report to be satisfied. They had to wipe it all out. Now, that individual might have had $50,000 of debt on the credit report. So for obvious reasons, you cannot eliminate $50,000 of debt with a $25,000 mortgage commitment. So what would happen is they would reach out to us and say, could you make this work? Could you make offers to settle to those creditors so that the $25,000 from the mortgage commitment can pay off the $50,000 of debt that is on the credit report? So that's where we kicked it off. We retained, or we were hired by the individual. put together a power of attorney, a limited power of attorney, so that we can negotiate settlement parameters and terms with the creditors or collection agencies or whomever had assigned the account from the bank. And when it was all finalized, we got it in writing and we had the payment made. So that's how it kicked off. And it was a new idea in the market. It was very what was the word I'm looking for here? It was a very favorable arrangement for all parties involved. It got the client the money they needed to get out of debt. It allowed the mortgage agent to close the deal, and it also allowed Total Debt Freedom to kick off a business model that is still successful today.
Yeah, well, it was a win-win situation for everybody except for the creditors. They didn't like taking less than what was owed, but it was really the only way to make things work. Otherwise, bankruptcy was pretty much the next option for them. So that's kind of evolved over time. We're in 2019 now. Is there a carve out in the legislation for mortgage agents or no? Like, are there any exceptions for them?
Under the Collection and Debt Settlement Services Act, I believe mortgage agents are not exempt. They may be. Actually, I think now that I think about it, I think mortgage agents are exempt. There's insurance agents, mortgage agents, accountants, lawyers.
Right.
I think those were the four trades, and trustees, of course, because they're under the Bankruptcy and Insolvency Act. Okay. So I think those were the five carve-outs for exemptions.
Yeah, we'll have to double check. I mean, the last time I saw it in 2015, it was just a carve-out for a lawyer, but I know they were talking about some other exemptions as well. We'll have to verify it. But I mean, you certainly want to be careful with who it is that you're dealing with when it comes to credit card debt. I mean, a mortgage agent's a specialist at placing financing, and they've got certain fiduciary obligations and training in place. I mean, we took the mortgage agent course, when was it, 2008, 2009?
Yeah, it was around that time.
Yeah, it was about 10 years ago. It was pretty intensive. I mean, we had to go to that school for a whole bunch of Saturdays, and then there was a test with that mortgage calculator. You basically don't, rely on tables. You're busting out all old school math to try to figure out what the amortization schedule would look like, depending on the APRs, compounded semi-annually, not in advance, blah, blah, blah. Really, really boring stuff. But I'm not aware of any training that mortgage agents would have to go through to try to settle debt. Are there any programs together that you're aware of? Because I'm not.
No, there's nothing I'm aware of. There's nothing I've heard of. It's quite frankly, I believe there might be a slight conflict of interest for the mortgage agents attempting to do the negotiation themselves. Mm-hmm. A lot of the time, the deals that the mortgage agents are getting are referred by the collection agencies themselves. The client is referred by the collection agencies. So what they're getting is a referral from a bill collector to say, hey, get this person some financing on the property, pay off my bill. And what they're doing then is they're generally paying that one account in full or very close to it in full. And they're making offers to settle on the other creditors, which is also then unfair to the other creditors. It's not a conflict of interest, but that is, there's a creditor preferential treatment in that regard. So you're basically paying one creditor more than you are paying another creditor, and it's unfair to those creditors who are getting paid the lower amount. So that's generally the way it works with the mortgage agents when they're getting the referrals from the collection agencies. And it just usually increases the amount that you're paying out. Because if you're paying out the agency at 80%, let's say it's a $10,000 account, and the referring party wanted 80% on that account, now it's $8,000 being paid out, and that leaves less money for the other creditors, which is technically it's unfair.
Yeah. So, I mean, this doesn't need to be a long broadcast. So just be careful, like tread carefully. I know we get people that are going to watch us throughout North America. We only service Canada, so we're not going to talk to anything that happens in the States, but certainly be aware that if you're being sold a bill of sale to get out of credit card debt by a mortgage agent, they probably don't have the skills and know-how or the experience anyway, I would say. I mean, our company's just been settling debt exclusively since, the early 2000s. And we took the mortgage course to try to understand the placement of financing, not to compete necessarily. But we're seeing a lot of mortgage agents offer the opportunity to get out of debt at a reduced rate. And well, we've done this tens of thousands of times when it comes to credit card debt. We have a massive database. We've got several thousand happy customers and rated A+ in the Better Business Bureau. I don't know that a lot of random mortgage agents have that level of success or track record of success anyway. So I would certainly do your due diligence. If you're in Canada and you've got credit card debt and what you're noticing isn't working, so you're throwing money at something that isn't reducing the balance on your credit cards, you may be a homeowner, you may be a renter, it doesn't really matter. It's certainly worth taking a look at getting a consult from our office if you want to get some more information about some potential options. And even if we're not the right option, we'll send you off in a good direction anyway. So what I'll do actually here, let me grab a link to the site. It's just totaldebtfreedom.ca. And I'll just post it in the chat and in the comments. If you guys want to get more information, you can always reach out to our office. Any closing thoughts, Andrew?
Well, the only other thing I was going to mention is obviously this topic's about homeowners, because you need to have property in order to do the financing. There are other potential avenues that you can take the same or similar approach. There are consolidation loans where you could potentially, if we're talking a $25,000 debt load, and you might want to go out and get yourself a $15,000 loan, consolidate it, 1 monthly payment, lower interest rate. That's a possibility. It's not ideal because you're just moving debt over from one or few creditors over to one creditor, but you are reducing your debt. So if it goes from 25 down to 10 or 15, that's ideal. If you can also get the interest rate reduced on the consolidation loan, then that might be possible. So if we're talking a primary institution, so I'm talking like the 5 big banks here in Canada, if you can go get yourself a loan at 7% to consolidate the 20% credit cards, that makes sense as well. So there's those options for those that have a smaller debt load. It's not going to happen for those that have, $50,000 of debt. You're not going to get a renter being approved for a $25,000, $30,000 consolidation loan.
Have you seen a financial institution like a lender bail somebody out of 19% credit cards or 28.8% retail store cards at 7%? Because I've never seen that.
It happens. Yeah, they have to be up to date on all their payments. They have to have a pretty good credit score, so over 670, 680. Then that can happen. So yeah, it usually has to be with the same bank too, like the one credit card product. So if we're talking, for example, TD, then you have to have a TD credit card and then a TD loan. So it's usually the same institution that will be willing to do that type of arrangement. But it's a possibility, and it's a reasonable option for those that have a good credit rating, who are up to date, who have a relatively small amount of debt, who want to eliminate their 20% credit cards for something around the 7% mark.
Got it. All right, there you have it, guys. Any questions or recommendations for future broadcasts, leave them in the comments below. Thanks for watching today. See you guys in the next one. We're aiming to do these every Saturday morning at 9 a.m. Eastern Standard Time. See you guys later.